Hi. In this video we will be talking about the surprising connection between taxes and inflation that affects your personal finances. Watch this video to the end to learn all about the importance money management. Welcome back to the International CEO. In the realm of personal finance, individuals often focus on various factors such as budgeting, saving, investing, and managing debt. While these aspects are undoubtedly crucial, another significant element often flies under the radar: the relationship between taxes and inflation. Surprisingly, the interplay between these two seemingly distinct economic concepts can significantly impact individuals' financial well-being. Understanding this link is essential for making informed financial decisions and navigating the complexities of the modern economy. Taxes and inflation are two fundamental components of any economy, each with its unique implications for individuals and businesses. Taxes represent the government's primary source of revenue, funding public services, infrastructure, and social welfare programs. Inflation, on the other hand, refers to the general increase in prices of goods and services over time, resulting in a decrease in the purchasing power of money. While these phenomena may appear unrelated at first glance, a deeper analysis reveals their intricate connection and the implications for personal finance. One of the most direct ways in which taxes and inflation intersect is through the taxation of investment gains. Inflation erodes the real value of investment returns over time, reducing the purchasing power of the profits earned. However, under the current tax system prevalent in many countries, individuals are often required to pay taxes on nominal gains without adjusting for inflation. This means that investors may end up paying taxes on gains that are merely compensating for the effects of inflation, effectively diminishing their actual returns. Consider a scenario where an individual invests in stocks and earns a nominal return of 8% over a year. However, during the same period, inflation averages 3%. While the nominal return may seem substantial, the real return after adjusting for inflation is only 5%. Despite this, individuals may still be subject to taxes on the full nominal gain of 8%, reducing their after-tax returns even further. This phenomenon, known as taxing inflationary gains, can erode the wealth accumulation potential of investments over time. Moreover, the interaction between taxes and inflation extends beyond investment returns to impact various aspects of personal finance, including wages, savings, and purchasing power. Inflation erodes the purchasing power of wages, reducing the real value of income earned by individuals. As prices rise, consumers find that their money buys fewer goods and services, effectively reducing their standard of living unless their income increases at a similar rate to inflation. However, tax policies may not always account for these inflationary pressures, leading to a situation where individuals face higher tax burdens without a corresponding increase in their real income. Furthermore, inflation affects the after-tax returns on savings and fixed-income investments such as bonds and certificates of deposit, CDs. When inflation outpaces the interest earned on these investments, savers experience a decrease in their real returns, effectively losing purchasing power over time. Again, the tax treatment of investment gains exacerbates this issue, as individuals may be required to pay taxes on nominal interest income without adjusting for inflation. Consequently, savers may find it challenging to preserve the value of their savings and achieve their long-term financial goals in an inflationary environment. In addition to these direct impacts, taxes and inflation can influence consumer behavior and economic decision-making in subtle yet significant ways. High taxes on certain goods and services can exacerbate inflationary pressures by increasing production costs and reducing consumers' purchasing power. Similarly, inflationary expectations can influence tax policy decisions, as policymakers seek to mitigate the adverse effects of rising prices on households and businesses. Understanding these dynamics is crucial for individuals seeking to navigate the complex interplay between taxes and inflation and make informed financial choices. Fortunately, there are strategies that individuals can employ to mitigate the impact of taxes and inflation on their personal finances. One such approach is tax-efficient investing, which involves optimizing investment strategies to minimize tax liabilities and maximize after-tax returns. This may include utilizing tax-advantaged accounts such as 401ks, IRAs, and HSAs, which offer preferential tax treatment on contributions, investment growth, or withdrawals. By strategically allocating assets across these accounts and taking advantage of tax deferral or tax-exempt opportunities, investors can enhance their long-term wealth accumulation potential. Diversification is another essential component of a tax-efficient investment strategy, as it allows individuals to spread risk across different asset classes and investment vehicles. By diversifying their portfolio, investors can mitigate the impact of inflation and market volatility on their overall returns, helping to preserve the value of their investments over time. Additionally, investing in assets that have historically outpaced inflation, such as stocks, real estate, and commodities, can provide a hedge against rising prices and help maintain purchasing power in inflationary environments. Moreover, individuals can explore tax planning strategies to minimize their overall tax burden and maximize their after-tax income. This may involve timing income and deductions to optimize tax efficiency, taking advantage of available tax credits and deductions, and consulting with financial professionals to identify opportunities for tax optimization. By proactively managing their tax liabilities, individuals can retain more of their hard-earned income and allocate it towards achieving their financial goals. Furthermore, staying informed about macroeconomic trends and government policies can help individuals anticipate and adapt to changes in the tax and inflation landscape. Monitoring inflationary indicators such as consumer price indexes, wage growth, and central bank policies can provide valuable insights into future economic conditions and potential tax implications. Likewise, staying abreast of proposed tax reforms and legislative changes can enable individuals to adjust their financial plans accordingly and minimize any adverse impacts on their personal finances. For instance, tax cuts aimed at stimulating consumer spending and investment can boost aggregate demand, potentially leading to upward pressure on prices. Conversely, tax increases may dampen consumer purchasing power and investment incentives, thereby mitigating inflationary pressures. Similarly, government spending programs, financed through taxation or borrowing, can influence inflation by injecting additional funds into the economy or by affecting the allocation of resources across sectors. Monetary policies, implemented by central banks to regulate the money supply and interest rates, also play a crucial role in managing inflationary pressures. By targeting an optimal inflation rate, typically around 2% in many developed economies, central banks aim to maintain price stability while supporting sustainable economic growth. However, the effectiveness of monetary policy in controlling inflation depends on various factors, including the credibility of the central bank, inflation expectations, and the transmission mechanisms of monetary policy. Inflation expectations, in particular, play a crucial role in shaping actual inflation outcomes, as households and businesses adjust their behavior and pricing decisions based on their expectations of future price levels. Moreover, the interaction between fiscal and monetary policies can influence inflation dynamics in complex ways. Expansionary fiscal policies, such as tax cuts or increased government spending, coupled with accommodative monetary policies, can fuel inflationary pressures by boosting aggregate demand and money supply growth. Conversely, contractionary fiscal or monetary policies aimed at curbing inflation can lead to reduced economic activity and lower price levels. In this context, individuals need to be aware of how government policies and macroeconomic conditions can impact their personal finances, including taxes and inflation. Changes in tax rates, deductions, credits, and government spending programs can have direct implications for individuals' disposable income, tax liabilities, and overall financial well-being. Similarly, shifts in inflation rates can erode the purchasing power of savings, investments, and wages, affecting individuals' standard of living and long-term financial goals. Furthermore, globalization and technological advancements have transformed the economic landscape, introducing new dynamics that influence taxes, inflation, and personal finance. Globalization has facilitated the movement of goods, services, capital, and labor across borders, leading to increased competition, interconnected financial markets, and cross-border investment flows. This globalization of economic activity has implications for taxation, as governments seek to adapt their tax policies to remain competitive and attract investment while addressing concerns about tax evasion, base erosion, and profit shifting. Similarly, technological innovations have disrupted traditional industries, reshaping employment patterns, consumer behavior, and business models. The rise of digital platforms, e-commerce, and the gig economy has created new opportunities for entrepreneurship and flexible work arrangements but has also raised questions about taxation, regulatory oversight, and income inequality. As individuals navigate these changes, they must consider the implications for their tax obligations, investment decisions, and financial planning strategies. In this evolving landscape, individuals can leverage technology and financial tools to manage their taxes and inflation exposure more effectively. Digital platforms, mobile apps, and online services offer convenient ways to track expenses, monitor investment performance, and optimize tax planning strategies. Automated investment platforms, robo-advisors, and tax-efficient investment products can help individuals build diversified portfolios and minimize tax liabilities while preserving purchasing power in inflationary environments. Moreover, individuals can explore alternative investments and asset classes to diversify their portfolios and hedge against inflationary risks. Real assets such as real estate, infrastructure, and commodities have historically served as inflation hedges, as their values tend to appreciate in periods of rising prices. Additionally, inflation-indexed securities, such as Treasury inflation-protected securities, TIPS, and inflation-linked bonds, offer investors protection against inflation by adjusting their principal and interest payments based on changes in the Consumer Price Index, CPI, or other inflation measures. Furthermore, individuals can take proactive steps to manage their tax liabilities and optimize their after-tax income through strategic tax planning. This may involve maximizing contributions to tax-advantaged retirement accounts, such as 401ks, IRAs, and Roth IRAs, to benefit from tax-deferred or tax-exempt growth. Additionally, individuals can explore tax-efficient investment strategies, such as tax loss harvesting, asset allocation, and capital gains management, to minimize taxes on investment gains and income. Moreover, individuals can stay informed about changes in tax laws, regulations, and economic trends to adapt their financial plans and investment strategies accordingly. Consulting with financial advisors, tax professionals, and legal experts can provide valuable insights and guidance on tax-efficient investing, retirement planning, estate planning, and other aspects of personal finance. By remaining vigilant and proactive, individuals can mitigate the impact of taxes and inflation on their financial well-being and achieve their long-term goals. The connection between taxes and inflation is an intricate web of economic forces that profoundly influences individuals' financial circumstances. In this extended exploration, we will delve deeper into the multifaceted relationship between taxes and inflation, uncovering additional dimensions and practical strategies for personal finance management. One crucial aspect to consider is the impact of taxes and inflation on investment decisions and portfolio management. Both taxes and inflation can erode the real returns on investments, reducing individuals' purchasing power over time. Understanding how these factors interact is essential for designing investment strategies that can withstand the challenges posed by taxes and inflation. When it comes to investment taxation, the type of investment account plays a significant role in determining the tax implications. Taxable investment accounts, such as brokerage accounts, are subject to taxes on investment gains, dividends, and interest income. In contrast, tax-advantaged accounts, such as individual retirement accounts, IRAs, and 401ks, offer preferential tax treatment, allowing individuals to defer or minimize taxes on investment income and gains until withdrawal. Strategic asset allocation is another crucial consideration for managing the impact of taxes and inflation on investment portfolios. By diversifying across asset classes with varying tax treatments, such as stocks, bonds, and real estate, individuals can optimize their after-tax returns while mitigating risk. Additionally, incorporating tax-efficient investment strategies, such as index funds, exchange-traded funds, ETFs, and tax loss harvesting, can further enhance portfolio performance and tax efficiency. Furthermore, investors can explore alternative investment vehicles and strategies to hedge against inflationary risks and minimize tax liabilities. Real assets, including real estate investment trusts, REITs, infrastructure funds, and commodities, have historically provided inflation protection and diversification benefits to investment portfolios. Additionally, tax-advantaged investments, such as municipal bonds and qualified dividends, offer opportunities to generate tax-free or tax-efficient income while preserving capital in inflationary environments. Tax-deferred retirement savings vehicles, such as traditional IRAs and 401k plans, allow individuals to defer taxes on contributions and investment gains until retirement, potentially reducing their current tax burden. In contrast, Roth IRAs and Roth 401ks offer tax-free withdrawals in retirement, providing valuable tax diversification and flexibility in managing retirement income streams. By strategically allocating contributions across these accounts, individuals can optimize their tax outcomes and maximize their retirement savings potential. Moreover, tax planning strategies can help individuals minimize their overall tax burden and maximize their after-tax income. By leveraging tax deductions, credits, and deferral opportunities, individuals can reduce their taxable income and optimize their tax liabilities. Common tax planning techniques include maximizing retirement contributions, harvesting capital losses to offset gains, and utilizing tax-efficient investment strategies. Estate planning is another critical aspect of tax management, particularly for high-net-worth individuals seeking to preserve wealth and minimize estate taxes. By implementing estate planning strategies, such as gifting, trusts, and charitable donations, individuals can transfer assets tax efficiently to heirs and minimize estate tax liabilities. Additionally, proper beneficiary designations and titling of assets can streamline the transfer of wealth and avoid probate expenses and delays. The relationship between taxes and inflation is a complex and multifaceted phenomenon with far-reaching implications for personal finance. Taxes and inflation interact in intricate ways, influencing investment returns, portfolio management, and tax planning strategies. By understanding this relationship and implementing proactive tax and investment strategies, individuals can mitigate the impact of taxes and inflation on their financial well-being and achieve their long-term goals. Whether through tax-efficient investing, strategic asset allocation, or proactive tax planning, proactive management of taxes and inflation is essential for navigating the complexities of the modern economy and securing a prosperous financial future. Thanks for watching. If you found this video helpful, please give it a thumbs up, hit that bell, comment, and subscribe for more content on the International CEO. See you next time.